Well, good afternoon. Thank you for joining us. This is Bob Stout. I am Churchill Stateside Group's National Director of Originations and Acquisitions. I'd like to welcome all of you to our HUD Bond webinar today that we're co-hosting along with Wade Norris. I appreciate having everyone here today. We'll try to make this as comprehensive as we can while still obviously being mindful of your time. A couple of things. Everyone is muted, but you can use the chat feature to enter questions. So as we go through the presentation, feel free to enter any questions into the chat box, and then we'll have time at the end of the presentations to try to answer as many of those as we can. You'll also see at the end of the presentation an opportunity to indicate whether or not you found today's information to be helpful. We'd appreciate your quick survey comment on that. And then also, if you would like to have someone follow up with you regarding any of the things we talked about today, you'll have an opportunity to enter that information as well. We will be sending copies of the full presentation out to all of the attendees within the next day or so, so be on the lookout for that. You'll have a complete set of slides. We do have a lot of information to cover. We're not going to have time to go through each individual slide, so if you want a deeper dive, you'll be able to do that when you receive those slides. So again, thank you so much for joining us. I'll give you just a quick overview on Churchill, and then I'll be turning it over to Dan Duda, who is our Associate National Director. Dan will be taking us through the HUD FHA insured mortgage products portion of the webinar, and then Dan will be turning it over to Wade Norris, who is our bond counsel. Many of you know, very active in the tax-exempt bond business and affordable housing. But Churchill is a full-service, privately held financial services company. We provide both debt and equity. We are an FHA MAP lender, a USDA rural development lender. We also have conventional programs, both for a privately placed unfunded forward product, as well as construction lending. Through our broker-dealer, Churchill Stateside Securities, we also are a bond underwriter, and that's where we handle the syndication of both federal and state tax credits. We also are a federal energy credit syndicator with a large practice in the energy business as well, but obviously today we'll be focused on our multifamily business. At this point, I will turn it over to Dan Duda, and Dan, you can take it away on the FHA products.
Great, thanks, Bob. Michelle, can you just move forward a few slides for me, please? Before we jump into the 4% side of things, I'll just give you a quick rundown on some of the other FHA products available. Churchill Stateside Group, we are a MAP-approved lender, which is on their multifamily side, but we're also, in addition, on the HUD approved list as well. What means on the FHA side is we have the ability to finance construction and sub-rehab, assisted living facilities, skilled nursing homes, and hospitals, and those programs are through the Section 232 loan programs and Section 242 loan programs. On the multifamily side, we do have the ability to do 223A7, which is a straight refinance of multifamily properties already with an existing FHA mortgage. What relates to the 4% side and LIHTC deals that we're working on right now is Section 221D4 loan programs, which is for new construction or sub-rehab. Now, this can be for the market rate side as well, but we're doing a lot of them for 4% and 9% deals. And also you have the Section 223F loan program, which is for acquisition or refinance or for mod rehabs. A quick rundown of the HUD regional offices right now. If you do utilize one of the FHA products, they have 5 main regional centers. West Coast being in San Francisco, the Southwest in Fort Worth, Southeast Atlanta, the Midwest, Chicago, and the Northeast, New York City. And they do have 7 other regional satellite offices that a deal may get processed with as well, but you start off with that main regional center. Their healthcare main office is in Seattle. Over the last few years, HUD has really regionalized their process. They have broken down and made the processing through these regional offices for purposes to make everything more streamlined. Streamlined meaning that more consistent in underwriting practices and what have you. And also in addition, in that streamlined process in those regional base offices, they do understand the markets a little bit better and therefore understand the market analysis, which quickens the overall process. To dive into a little bit more on the specific products that work well with 4% LIHTC executions is the HUD 221D4 and the 223F, like I mentioned before. The 221D4 loan and the 223F loans have no loan amount limitations. They also have fixed and locked interest rates for the life of the loan, which typically closes right before, which is rate locked typically right before equity and the loan closing. On the 221D4 side, again, this is for new construction and sub-rehab. This is non-recourse financing, has a term of 40 years, an amortization of 40 years, and rates are currently in the mid 3%. Since it is affordable for a 4% deal, you'll be able to benefit from a 25 basis points MIP. And or if it's built green, you'll be able to benefit from a 25 basis point MIP as well. Loan to cost are allowed up to 90% if you have 90% or more of rental subsidy that is going towards the project. For standard LIHTC deals that do not have the 90 or more percent rental subsidy, you can go up to 87%. On the market rate side, it's 85%. So real good loan to cost terms there. On the min debt service coverage ratio side, you can go as low as 1.11 for properties that have 90% or more on rentals subsidy. But for standard LIHTC deals without that, you can go typically a 1.15. On the 223F side, that's for mod rehab and or acquisition and also refinance. However, to qualify that on the mod rehab side, you cannot replace 2 or more major systems, or you also cannot have costs greater than $15,000 times the high cost factor. This is non-recourse financing as well. Term is 35 years, amortization is 35 years, and you have rates in the low 3s. Just like the 221D4, you can benefit from the low MIP, 25 basis points for affordable, and if built green, 25 basis points as well. And that does also have the high loan to value and also cost restraints of 90%. And you can also have a 1.11 debt service coverage ratio. Just wanted to point out also too right now, the 223F does require a 3-year of stabilization. That has been the case in the past. However, HUD should be issuing a mortgagee letter by year end to waive that requirement. So that's more on the 9% side. That could be a good fit. It could be a takeout construction loan and fit well with that. As you can see, these terms are very favorable. Obviously, on 4% deals, you're going to need a lot more debt due to the lesser allocation of the tax credits at that 4% rate. So these really work well at 4%. On to the next slide. Financing benefits. So these are, as you can see, the most attractive terms in the market. You're not going to be able to find any other products with rates in the 3% with 40-year terms and 40-year AMs. This is interest only through the construction period. You have those low debt service coverage requirements and also those high loan to costs and loan to value constraints up to 90%. Just wanted to point out on a HUD 221D4 as well, there is no loan to value constraint. It's just loan to costs, where I know other programs out in the market may have an 80% or 90% loan to value. Also too, this is non-recourse construction financing. I think this is important. There's many deals that happen that something goes wrong throughout construction period where personal guarantees are executed, which could cause lots of harm to the developer and owner. In this case, this is non-recourse since it is insured and backed by HUD. Also too, another positive about utilizing HUD financing is that there is, for a D4 specifically, is that there is one closing. That closing happens at equity closing. So it also is funded throughout the construction period. There is no perm loan closing, so there minimizes lease-up risk later on to conversion. Positive to transformation. HUD went through a transformation years ago to regionalize the HUD underwriting offices to make it more streamlined. This makes more consistency throughout the offices, which allows us HUD lenders to put the best package together and to know exactly what they are looking for. They are currently streamlining underwriting for LIHTC deals. If you do, for example, if you do a market rate deal, there is actually a pre-application stage. If you're doing a LIHTC deal, you actually can skip that pre-application stage, submit directly to firm application, which saves 1 to 2 months. In addition, HUD has rolled out a one underwriting type of model, meaning that they assign one HUD underwriter to the deal that has ownership of it to make sure it goes from A to Z as quickly as possible. In the past, they would send it to one department, to the next department, to the next department to get approvals. So this has definitely quickened the timeline. And just in this past year, HUD has rolled out a pilot program on both 9% deals and also 4% sub-rehab deals. Essentially what it does is any LIHTC deal that is submitted to HUD, they pretty much put it on top of the queue. HUD has really made an effort over the last 4 or 5 years to do more affordable business. As you can see through the transformation, the pilot program, and they also over the MIP fee a few years back, they really are putting a concentration of getting these through quicker. There are some road bumps going through the HUD 221D4 and 223F process, just like any other program will have. Some big things that we like to address first are environmental items. If there is anything that could be of an issue up front, for example, floodplains or wetlands, you just want to make sure you're working on that sooner rather than later. There is mitigants to that. If you do have something like that, there is an 8-step process that you need to go through. So just make sure you are talking to your lender up front about that to see how you can mitigate that. Experience is also another crucial aspect to moving through the HUD process. You just want to make sure that if you do not have HUD experience, that maybe you surround yourself with someone a general contractor or a management company or an architect that may have that HUD experience, at least the LIHTC experience. The more experience, the better. Equity requirements on LIHTC deals. HUD does have certain benchmarks that you need on the equity side to come in through construction. The major one is that you do need a 20% true equity from a syndicator at the D4 closing up front. There is other benchmarks throughout the construction process. However, you can use bridge loan proceeds to kind of mitigate that. Another also road bump is you do need plans and specs. You pretty much need a full set before you actually submit your firm application to HUD. So what we recommend is to start working on those sooner rather than later. However, now with the new pilot loan program, 80% of plans only need to be completed when you actually submit the firm 221D4 application. I would want to point out, though, that timing is not as much as an issue as people think these days, especially with LIHTC deals. As you can see through the transformation and the pilot, that they really are making a conscious effort to get these deals to the finish line as soon as possible. I think it's very important to have the right team in place and a lender who knows how to navigate the HUD landscape. There are certain hot buttons that HUD has, and we know them. We know how to address them early, and we know how to mitigate them. In addition to that, we know how to push and pull HUD in certain ways to make sure that they're working as quickly as possible to issue that commitment and also get to a closing. Speaking of the process, typically what we'll do at Churchill is we like to get into the deal quite early and work with our developer clients, help structure the deal. Through our capabilities, we do have the ability to provide the HUD 221D4 debt. We do have the ability to federal syndicate, and we do have the ability to bond underwrite. With all those capabilities, we understand all pieces of the pie, and we can help structure that deal. On the debt side, we can obviously include any mortgageable items, include any HUD-associated costs. On the equity side, we can help you determine eligible basis, and we can even dive deeper and look into QAPs with you and incorporate any requirements that is going to require. On the bond side, as you hear from Wade in a little bit, we work closely with Wade and can help determine bond issuance costs, trustee costs, and things of that nature. Once you're comfortable with that with the structure of the deal and the deal makes sense to proceed, we then go ahead and engage in the 221D4 application. What that does with Churchill is brings the team to the table, and we get our underwriters involved and move to the next step. That next step is doing a concept meeting with HUD, and typically what this is tip of the iceberg type items that we go over with HUD. We discuss the overview of the deal, unit count, location, things of that nature, and also talk about the development team participants and the experience that they have. After, also too, that's a good spot where we iron out any potential issues, such as environmental or experience type issues, and help mitigate that. But as a LIHTC deal, this is a pretty simple process, and they essentially approve it that day and tell you you have approval to submit direct to firm application. After we get that concept meeting approval, we typically go ahead and order HUD third-party reports. HUD requires us as lender to order the appraisal, market study, phase 1, and architect engineer report. So just a bit of advice too, if you're thinking about going this route, please incorporate us when you're engaging any of those third parties for tax credit application purposes. We can tell you some of the firms that we like to use and that are reputable in the HUD world, and maybe they can use that for tax credit application purposes to help reduce your overall costs. The final stage, which usually is a big thing that determines the timeline of the HUD 221D4 process, is approving of the final plans and specs. Now, with the new pilot loan program, we only need 80% to submit to firm, which is going to be helpful. But please bring us early into that so we can get our architect and engineer working with your architect to make sure that everything is conforming to HUD MAP guidelines. After we get all third parties, all due diligence, we can then go ahead and submit direct to firm application. Now, nowadays, the HUD 221D4 firm apps are taking about 30 to 60 days to be completed and reviewed, and for HUD to issue a 221D4 commitment. And we typically can close 30 days after HUD issues that. While we're waiting for the HUD to review the 221D4 application, we typically engage counsel on the 221D4 side to work on loan docs, and also try buttoning up everything on the equity side with the limited partnership agreement, and also make sure everything is all set on the bond issuance side of things. So really, we'll just be waiting for HUD to issue that commitment to work towards that closing. A case example, this is I'll give you a brief case example that we closed about 2 years ago, and actually in the last year, or the last 3 months or so, just became the final endorsement and is now 95 to 100% leased up and occupied. This is a 200-unit new construction deal located in eastern North Carolina. Now, if you look over to the right side, as you can see, that HUD 221D4 of about $16 million makes up a big portion of the capital stack. Reason being is that since they are 4% tax credits, they're not getting as many tax credits as they would on the 9% side. And this HUD 221D4 really helps make this deal work due to the 40-year term, the 40-year amortization, and the low rates. As you can see, there's a minimal deferred developer fee here of only $240,000. On the left side, you'll see the uses. Land acquisition of approximately $500,000. You have hard costs and contingency in the $18 million range. Now, at 200 units, this is only about $90,000 a unit. This was about 2 years ago. Costs have gone up all across the country, and we're seeing anywhere in the $100,000 to $150,000 range on cost per unit. So just please keep that in mind. Debt bond LIHTC costs in the 1.3 range, soft costs in the $3 million range, reserves and interest about 1.7, and a healthy developer fee of 1.7. The bottom right, you'll see a bond issuance of approximately $13.5 million. I'll let Wade jump into that in a little bit on that side of things, but we're just going to make sure when we're structuring that 50% of the total development cost, that there's at least 50% of bond issuance coming into the deal to make sure it qualifies for the 4% LIHTC. In addition to that, we do have the ability to help out in 4% deals to provide free development money at times and help take down the land. So just please keep that in mind and feel free to reach out to us if you have any questions about that. In closing, We would love to help structure your deals. We can look at it from the debt, bond underwriting, and equity perspective. It can help you also run eligible basis calculations, incorporate bond and debt underwriting costs, and even help determine projected rents, expenses, and GC costs. We have all the utilities and tools to help structure these types of deals, so please feel free to run any of these ideas off of us at any time. We have been very successful with this product, and our team has tons of experience. Our HUD underwriters are go-getters and deal makers, and our staff is very experienced. We have very good relationships with a lot of the HUD staff, which also helps quicken the process and make it more efficient. With that, I will pass it over to Wade. Thanks.
Hey, Dan, real quick, and Wade, there is a question on here before we move on. I don't know if you want to take this on. It says, I understand that we can do 80% plans, but what happens when the plans are complete? Does HUD want the city approvals prior to the application?
Yeah, so the more complete the plans, the better, for sure. We would like to see that. HUD likes to see that, so there's no changes later on in the process. HUD wants the approvals prior to application. Permits can be approved later on after FIRMAP. It just needs to be in place before closing. I hope that answers that question.
Great, Wade?
Okay, thanks. And Michelle, do I hit page down to click through the slides, or how do we do that, or will you do that for me?
Yeah, I can just do that for you if you want to just say next slide.
Oh, okay, that's great. Let's go on to the next slide then. Thanks. Well, my name is Wade Norris. I'm a partner in the law firm of Norris, George, and Ostro. We're a 7-lawyer boutique law firm based in Washington, D.C., but we have lawyers in San Francisco, Denver, Louisville, Kentucky, and Albany, New York. We specialize in tax-exempt municipal bond financing, generally serving as underwriters counsel to firms like Churchill Stateside Securities, who underwrite municipal bonds. Sometimes we serve as co-counsel to banks in private placements of tax-exempt municipal bonds. And our primary emphasis here is on tax-exempt multifamily rental housing bond finance. To save you the gory details in these two slides, basically our lawyers over the last 3 years have closed over 425 deals in 37 states. We're very active in this space, and we did help pioneer this short-term cashback tax-exempt bond structure that we're going to chat about later on in the webinar today. And let's go 2 slides further down if we can, Michelle. Yeah, let's skip that one. Okay, so we talked a little bit about 9% tax credits. 9% credits are a wonderful thing if you can get them, as Dan alluded, but they are, of course, 4 to 5 times oversubscribed, and that's not really our focus here today. If you aren't able to get 9% credits, the other way to finance an affordable rental housing project is to use a combination of tax-exempt bond financing and 4% low-income housing tax credits. Let's go to the next slide, Michelle. The 4% credits aren't as powerful, but as you can see from this data, bonds and 4% credits in 2016 financed about 75,000 apartment units across the United States, even more now than the 9% credit does. So a very important affordable housing finance. The next slide, Michelle. What we're going to focus on today are 100% affordable projects, which are projects where all or substantially all of the units are occupied by persons at 60% of area median income. This is for a family of 4, and as you know, we adjust it up or down for family size. We also cap rents at 30% of that amount to be eligible for the 4% tax credit equity. Let's do the next slide, Michelle. You will hear tax-exempt bonds being used on large, mixed-use urban projects where 20% of the units are affordable, usually at 50% of area median income. This is a picture of Trans Bay 8, a project we financed in downtown San Francisco in 2016, but that's not the subject of our discussions today. We're focused on the 100% affordable deals. So let's go to the next slide, Michelle. And let's go on one more. Now, to have an affordable housing have an affordable multifamily rental financing on these 100% affordable projects, you've got to have the 4% tax credit equity. That typically funds, as most of you know, 30, 35, 40% of total development costs, as was the case in the example Dan gave. Without that, we have no deal. But to be eligible for the 4% tax credit equity, there's the all-important 50% test. That means that the borrower must finance at least 50% of the basis in the building and land with volume-limited tax-exempt private activity bonds under Section 142D. 501c3 bonds don't work here. And we have to keep these bonds outstanding until the project's placed in service date, which generally means for a new construction or sub-rehab deal, the receipt of the certificate of occupancy. For a mod rehab deal, generally when you're finished with the rehab process. Why is there a 50% test? Why do you have to finance with bonds to be eligible for the 4% tax credits? Well, while the process for getting a bond volume allocation is not as rigorous as it is to get a 9% tax credit allocation, nonetheless, the 4% tax credits were viewed by Congress as a substantial federal subsidy. They wanted there to be some group that would pass on the public merits of the project for the borrower to be eligible for this subsidy. And so they piggybacked on the private activity bond volume allocation process. So if you can go in and score high enough in a state to get a private activity bond volume allocation, and if you follow the parameters of this rule, then you'll be eligible for the 4% tax credits. If you're not, then you will not be, and that's why the test is in the code. Let's go to the next slide. Now, we discussed the 4% tax credits, obviously not as powerful as the 9s. And since the Tax Cuts and Jobs Act, the pricing has come down, but it may be as high as 90% in some jurisdictions and up towards $1 in jurisdictions in your urban areas where there are big CRA needs. Let's go to the next slide, Michelle. Here's a quick example of the computation of the 4% tax credits. This is on a $25 million total development cost. Take out the land, we got 21.5 million. If we're in a difficult to develop area, we get to multiply by 1.3. We're then going to look at our tax credit rate times our adjusted basis. Now, the 4% tax credits at present are like a Baby Ruth candy bar. The package actually looks a little bit bigger than what's inside. It's not really 4%, it's 3.2%. So we multiply there is legislation pending in Congress, which you may have heard about, which will make the 4% a real 4% if we get that passed. There's some hope that may happen by the end of the year, but we'll have to wait and see. But for the moment, we multiply our 28 million of adjusted basis, taking into account the difficult to develop area multiplier, and we get 894,400 per year of tax credits flowing for 10 years, or about 8.9 million aggregate value at a 95-cent purchase price, 8.5 million, which is about 35% of total development costs. So this is just a typical calculation of how this works. Let's go to the next slide, Michelle. Here's sort of a sample of sources and uses. Again, I think Dan covered that well, so we'll skip this slide for purposes of what we're doing here. Little sample of cost of issuance on a $20 million deal. How much does it cost you to do the bond side of the deal? Well, you've got to pay the cost of issuance. Without the bonds, you don't get the credits. Without the credits, you have no deal. So it's just a cost of doing an affordable housing deal. Here's just a guesstimate. Issuer fees can range widely. All of these can range widely, but you might expect the bond cost to be 2.5 points, 3 points, depending on the size of the deal, maybe a little bit less on a really large deal, etc. That'll give you a general feel for it. This is something you're going to pay out of pocket or out of tax credit equity. Now, how do we finance? If your project is eligible, if you're geared toward FHA financing, if that works for you, 221D4, 223F, if that's the program you want to use, or if you have a rural development project and you want to use that program, those loans, the lender, Churchill Stateside Mortgage, can actually wrap the advances on those loans with Ginnie Mae full faith and credit government securities. And they can sell those securities in the taxable mortgage markets to finance these loans. And that's what happens on a market rate deal. And before the financial crisis in 2008, we would do something different. We would take those Ginnie Mae securities and we would pledge those as collateral for long-term 35 or 42-year municipal bonds. And we would use the proceeds of those long-term municipal bonds to finance the mortgage loan to the borrower. Why did we do that? Well, at that time, the long-term muni bonds were rated double AAA. They were backed by Ginnie Mae's, strongest credit you can get, and the buyers of those bonds did not pay federal or state income tax on the interest they receive on those bonds. As a result, up until the financial crisis, the rates on those long-term muni bonds backed by Ginnie Mae's were much lower than if we just took the taxable Ginnie Mae's, where the recipients are paying federal income tax on the interest they receive, and sold those in the taxable mortgage market. So we put the Ginnies behind long-term muni bonds, and for the first substantial portion of my legal career, that's the way we did these deals. Let's go to the next slide. And you'll see from this chart, you know, the blue line there is the 30-year U.S. Treasury security. The red line is a tax-exempt long-term muni bond index, a 20-year bond index. And you'll see for most of history, from '83 up until September of '07 in this slide, the red line, the tax-exempt index, is below the blue line, which means that we could get a much lower rate by pledging the Ginnies to long-term muni bonds. Let's go to the next slide. For example, at that time, a taxable bond, long-term bond, might have been rated 6%. The tax-exempt long-term bond may have been rated 5%, 100 basis point savings. That's why we use long-term muni bonds. Let's go to the next slide. Now, what were the benefits? We qualified for 4% tax credits. We saved 50 to 100 basis points on the rate as compared to selling taxable Ginnie Mae's. A negative, for a new construction deal, a 221D4, the bond issues were fully funded, these long-term muni bond deals, and we would have bonds out there at a 4.5% or 5% rate. We'd be reinvesting during construction or sub-rehab at 1.5 or 2 points, which is a huge amount of negative arbitrage, and the rating agencies would make you fund that up front, which was a very difficult requirement on these deals. We'd make it work from various sources, but very tough. In addition, when we do a long-term muni deal, we're going to have ongoing fees to the issuer, the trustee, rebate fees. This is over and above the fees on the FHA loan or an RD loan for the entire 35 or 42-year period that the bonds are outstanding. With some issuers, those fees might be 7 or 8 basis points. With other issuers, state agencies in particular, it may be much higher than that. And so another advantage of doing short-term tax-exempt bond financing versus this long-term financing is once you're placed in service, that additional layer of expense goes away. Let's go to the next slide. Now, the way I just described we did these deals is the way we did these deals in the 50s, and this is kind of fun. Watch the pictures here. The 60s, the 70s, the 80s, the 90s, and up until '07. Okay, the early 2000s. And so for years, this is just the way it was until, Michelle, boom, the 2008 financial crisis, which is sort of the extinction event for a lot of long-term debt financing platforms. And let's go to the next slide. What happened in the '08 financial crisis, as you'll all remember, is we had a huge dislocation in the markets. Long-term debt buyers all over the world purchased hundreds of billions of dollars of double and AAA rated debt securities, which became worthless. If you bought Lehman Brothers paper, it was double AAA rated. Fannie and Freddie went into receivership, conservatorship, etc. It became worthless. Or if you bought the CLOs, CMOs, CDOs, whatever, hundreds of billions of dollars were worth 5 or 10 cents on the dollar. So the entire world debt, long-term debt financing markets fled to the safety of U.S. Treasury bonds. That's all they wanted to buy. In January of '09, this was the market for long-term debt. Anything and everything else, including long-term muni bonds, the rates soared as compared to the rates on U.S. Treasury bonds because the demand for the Treasuries was so high following this huge violation of trust in the debt markets. It was the only thing the debt buy side trusted. And so the result of all of that was, let's go to the next slide, interest rates went upside down. If you look at that downward pointing arrow, you'll see the blue line in this case is the tax-exempt MMD index. The red line is a 10-year U.S. Treasury. And you'll see on the left side of the chart, the blue line for the most part of that history up until the crisis was below the red line, i.e. what I described earlier, you get a lower rate financing with long-term muni bonds. But you'll see in January of 09, that flipped dramatically upside down. Suddenly, the blue line is 400 basis points higher than the red line, i.e., if we finance our FHA-insured loan or our loan through the sale of taxable Ginnie Maes being the full faith and credit of the U.S. government and trading at a very tight spread to Treasury securities, we could get a dramatically lower rate than if we finance that loan through tax-exempt muni bonds of any sort, even tax-exempt muni bonds backed by Ginnie Maes. Now, you might say, well, wait a minute, that doesn't make any sense. No, it doesn't, except that the only thing the market's trusted in this post-08 era is they want to buy that full faith and credit of the U.S. government in a highly liquid, taxable security, and the other features, the long-term muni bond backed by the Ginnie Maes, get lost in the mix. So we can achieve a much lower borrowing rate in the post-08 era by just selling the Ginnie Maes, having Churchill stateside mortgage, sell the Ginnie Maes to taxable institutional buyers in the marketplace, using that to fund our loan rather than long-term muni bonds backed by those Ginnie Maes. Let's go to the next slide, Michelle. So we're still in this upside down interest rate world, kind of a fun slide, but let's go to the next one. And so the question is, well, in this kind of a world, why are you going to do any bonds at all? You know, I mean, just do the taxable loan sale, taxable Ginnie Mae sale, fund the loan, and you're done. Oh, wait a minute, I'm sorry. You've got to remember the 50% rule. We have to finance at least 50% of our land and buildings with tax-exempt bonds, keep them outstanding until placed in service date to be eligible for the 4% tax credit. So Michelle, let's go to the next slide. So what we came up with was a short-term cashback tax-exempt bond structure. We're going to do that to satisfy the 50% test, and that's all these bonds do. They don't provide a dime of additional debt financing into the deal. That's coming through the FHA loan or an RD loan and your tax credit equity and the other sources Dan described. But what these bonds do is they magically convert those lender advances with respect to that loan from just regular monies into tax-exempt bond proceeds when they are used to fund the project cost, which primes the 50% rule and makes us eligible for the 4% tax credits. What we do is we establish two funds under a trust indenture. Basically, we'll set a maturity on these bonds of maybe 3 years. We often sell them to a 2-year mandatory tender if we think our project place in service date is 12 or 16 months or 18 months. We think we'll be finished by month 24, and then in that case, we'll just redeem the bonds. If we're not, we can remarket for a 12-month period and keep the tax-exempt debt outstanding to make sure we got plenty of time to satisfy the rule. And on day one, we're going to have a project fund under the indenture and a collateral fund. Now, in Dan's example, where we had $13.5 million of bonds to finance the $26.5 million total development cost, basically all the $13.5 million is going to go into the project fund at first. The collateral fund is going to be empty, but at the moment, at this point in time, the principal of the bonds is fully cash collateralized by the money sitting in the project fund. And over time, as the FHA lender advances come in, we're going to put them in the collateral fund, take an equal amount of money simultaneously of tax-exempt bond proceeds out of the project fund to pay the project cost, but we will always have a combination of $13.5 million in those two funds. The rate on the interest rate to provide for interest on the bonds, we'll invest at closing in 2-year Treasury securities. Let's say that in the current market, those yield about a 155. Our bond coupon for 2 years will be about a 150. Now, we can't keep that positive arbitrage in most cases, but nonetheless, what that tells you is there's no negative arbitrage. The earnings we'll get on these 2-year treasuries should offset the interest we have to pay on the bonds. And so we are fully cash collateralized on principal. We're going to be fully collateralized with respect to interest. We get a AA+ rating from Standard & Poor's without any other form of credit enhancement. When we are placed in service, we redeem the bonds, they've served their purpose, and we're done. Now let's see how this works step by step in practice. Okay, now fasten your seatbelts on this. We're going to go through 12 steps here, but it will show you how these deals work and how things flow. We've got the tax-exempt municipal issuer at the top. That was the Housing Authority of the City of Wilmington in our case study that Dan did. They have a bond trustee. We've got our 2 funds and accounts that we've discussed. We've got Churchill Stateside Securities as our bond purchaser or the underwriter over on the left-hand side. On the right-hand side, we've got the Ginnie Mae purchaser, because there'll be a separate sale of Ginnie Mae's to the institutional purchaser of the taxable Ginnie Mae's. Have our borrower on the lower left. We got Churchill Stateside Mortgage as our FHA or RD lender in the middle, and we got Ginnie Mae over there on the right. Now, step 1, Michelle, there we go. So the first step is the issuer will deliver our 2-year bonds, mandatory tender 2 years, $13.5 million, S&P AA rated, to Churchill Stateside Securities as the underwriter. Step 2, CSS will deliver the $13.5 million of bond proceeds to the trustee for deposit to the project fund. Step 3, the trustee is going to invest those in the 1.55% 2-year U.S. Treasury securities and hold a little bit of cash for investments to secure the bonds. Step 4, down in the lower left. Now, at this point, the borrower is going to make the initial loan request. Let's say we've got a 221(d)(4) loan to Churchill Stateside Mortgage as the FHA lender. Now, step 5, watch step 5. Now, you notice normally in a market rate deal, step 5, the first loan advance would go directly from Churchill Stateside Mortgage back over to the left to the borrower, right? But we're not going to do that here. This is where our little magical conversion mechanism comes into play. Instead, Churchill Stateside Mortgage will make that lender advance to the trustee for deposit to the collateral fund. Let's go to step 6. And the trustee is going to send bond proceeds in an equal amount down to Churchill Stateside Mortgage, who in step 7 advances that money to the borrower to cover the first stage of our project cost. So by doing this little flow-through mechanism, we've magically converted the FHA lender advances into tax-exempt bond proceeds when they go into the project as the 50% test requires. Now, at the moment, Churchill Stateside has drawn its warehouse credit line to fund that initial draw. They're out the amount of initial draw. But here's how we take care of them in step 8. They request Ginnie Mae to issue a Ginnie Mae security with respect to the first FHA loan advance. Step 9, 2 weeks later, Ginnie Mae issues it. Step 10, Churchill Stateside Mortgage delivers that to the Ginnie Mae purchaser they've lined up in advance. Step 11, the Ginnie Mae purchaser pays the purchase price for that initial Ginnie Mae construction loan certificate, and Churchill Stateside Mortgage is now reimbursed for the loan advance. Now, this little cycle occurs monthly on each advance until finally the project is the loan is drawn down, the project's placed in service, and finally in step 12, once we are there, the project fund is empty, the collateral fund has been filled up, $13.5 million. We've covered all of our interest through the Treasury earnings, and boom, we use the $13.5 million in the collateral fund to pay off the bonds, and we're done. Now, at this point, let's go to the next slide, Michelle. At this point, we don't need this slide. Let's keep going. This can be after study. Now, what we've done here, the net result in this slide is, if you look at the left-hand side of this chart, had we done this deal the old way with long-term muni bonds, the all-in borrowing cost would have been about $435. By doing it this way and selling taxable Ginnie Mae's to fund the loan, we've dropped that cost to $330, $385, a significant reduction in the interest rate. May not be quite that high in the current market, but it's still far and away the best execution. Let's go to the next slide. Plus, on a new construction deal, we've avoided 3 to 7 points of negative arbitrage deposit up front we would have had to make on a 221D4 loan had we financed it with long-term, fully funded muni bonds under the old mechanism. At the current level, with a 155 on the treasuries and a 150 coupon on the tax-exempt bonds, we don't have any negative ARB. That's very close right now. We could slip back into negative ARB and have to fund a little bit on the bond side of the deal, but at the moment, it wouldn't be a huge loan amount, and this structure still is far and away the preferred execution for these deals. Michelle, let's go to the next slide. So where are we at the end of the day? We've qualified the project for the vital 4% low-income housing tax credit financing. We've lowered our mortgage loan rate, our all-in borrowing cost, by probably closer to 50 basis points in the current market, maybe 75 over what the other execution would be. Still significantly better. We've avoided a huge negative arbitrage deposit we would have had to make on a 221D4 deal. And once we're placed in service in year 2, we've eliminated any ongoing bond side ongoing fees. The disadvantages, really none. So sort of that's it in a nutshell. We have some other slides here, but I think Dan covered those points well. I think we're good to go, and we should open it up for questions. And certainly you will get all of the slides, as Bob mentioned at the outset, in an email. We're also going to send you a little short description of short-term cashback bonds that Ethan and I put together that explains it and may be useful to you in explaining it to others. But that in a nutshell is what short-term cashback bonds are, why we do the tax-exempt short-term cashback bonds, the purpose they serve, and how they work. And I'd be glad to answer any questions that anyone might have. Thank you.